If you're a Canadian taxpayer, listen up. Your 2025 tax return isn't going to look like any other year. In July, the federal government cut the lowest income tax rate from 15% to 14%. But here's the catch. That's only for half the year. That means the effective rate for 2025 is about 14.5%. And if you don't plan carefully, you could either leave money on the table or face a surprise bill next spring. Stick with me. I'll show you exactly how this works and what you should do before you file. First, let's break down the blended rate. Your employer, or the CRA, calculates payroll and installments, assuming the old 15% rate for January through June, then applies 14% starting in July. The result? Most Canadians end up paying more tax upfront than necessary. By understanding how the blended 14.5% rate applies, you can make small adjustments to avoid overpaying or underpaying, and potentially keep hundreds of dollars in your pocket. Now, how do you check if you're on track? Step 1. Review your payroll, withholding, or tax installment payments. Look at your T4 or your CRA My Account summary to see how much tax has been deducted each month. If your employer didn't adjust your payroll correctly for July onward, it might be time to request an update or increase your deductions later in the year to compensate. Step 2. Consider timing your income and deductions. If you're contributing to an RRSP, deferring income, or planning capital gains, 2025 is unique. For instance, contributing to an RRSP in December versus January could shift the deduction into 2025 or 2026, affecting your effective tax rate and refund. Step 3. Review your credits and deductions carefully. Medical expenses, charitable donations, and other deductions can be strategically timed to maximize tax savings. Since the 14% cut only applies for part of the year, you might be able to shift income or deductions into months where they'll have the most impact. It's all about planning ahead, rather than waiting until tax season. Here's a simple example. Imagine you earned $50,000 in 2025. For the first half of the year, you were taxed at 15%, and for the second half at 14%. If your payroll wasn't updated, you could have overpaid several $100s. By adjusting your last RRSP contribution or even reviewing your installment payments now, you can lock in that saving before you file. Small moves like this add up, and they compound if you're managing multiple income streams or investments. Bottom line, the 14% tax cut is real, but the timing makes all the difference. Review your withholdings, consider end-of-year RRSP or deduction strategies, and plan your income recognition carefully. Doing this now means more control over your 2025 return and avoids surprises when you file next spring. If you want to dive deeper, I've linked official resources from the Department of Finance and taxtips.ca in the description so you can see exact numbers and rates. Don't leave money on the table. Hit subscribe for more Canadian tax tips, check your payroll now, and start planning your 2025 return the smart way.